The RBA lifted the cash rate by 25 basis points at its March meeting. This was the second consecutive interest rate hike this year from the Reserve Bank of Australia. And the primary reason is inflation is too high. Growth in the Australian economy is running above its speed limit. That is contributing to higher inflation, and the labour market remains in a solid position. Of course, what we've also seen in recent weeks is developments in the Middle East, adding to challenges around inflation. So lifting interest rates at its March meeting will help give inflation the best chance at returning to target by slowing demand in the Australian economy. One of the interesting things that we saw in the accompanying statement by the Reserve Bank is that was a split decision in March. We saw 5 board members vote for a rate hike, whereas 4 members voted to keep interest rates on hold. In the accompanying press conference, what we learned is that split decision was not about whether or not interest rates should move higher, it was about the timing. A real decision between lifting the cash rate in March or waiting for more information and lifting the cash rate in May. Between now and that May board meeting, the Reserve Bank will be very focused on how the domestic economy is performing, how households are behaving after 2 rate hikes and higher energy prices. Will we see consumer demand react? That will be their primary concern. But we also know they'll be watching developments in inflation very closely, as well as data on the labour market. Offshore developments will, of course, be another key watch point for the Reserve Bank. We are expecting the conflict in the Middle East to escalate and be a months-long conflict, not a weeks-long conflict. And that obviously raises the risks for both inflation and the growth outlook, both domestically and internationally as well.